Okay, let's dive into this. Right now, we're seeing a massive, honestly kind of jarring disconnect in the financial world. Traditional markets are absolutely booming, but crypto? Crypto looks like a completely different universe. Today, we're unpacking the source data for this explainer to figure out what's driving this split and why this invisible magnet we call fair value is pulling so hard on both markets.
$1 billion. Let that sink in. That staggering amount of crypto liquidations just recently hit the market as Bitcoin took a pretty nasty sudden plunge. You know, when you see a number with that many zeros just wiped out, it naturally causes widespread panic. The headlines are screaming about a free fall, and retail investors are left wondering if the bottom has just completely fallen out of the whole digital asset space.
And the FOMO? The FOMO is incredibly real right now. Think about it. On one hand, you've got crypto bleeding out through these massive liquidation cascades. But on the other hand, Wall Street is hitting all-time highs, completely fueled by this wild AI euphoria and IPO hype. It really begs the question, why on earth would anyone hold a crashing asset when literally everything else is rocketing straight upward? Well, to make sense of it all, here's our roadmap for this explainer. First, we'll look at why crypto is crashing. Then, the historical bottoming process, fear, volume, and fair value. After that, we'll zoom out to some mega trends like regulation and tokenization, and finally, we'll wrap up with patience and mean reversion.
All right, Section 1. Why is crypto crashing?
So, the immediate technical catalyst for this whole slide is something called a bear flag. For those of you who watch the charts closely, you know this pattern usually signals that a downward price trend is, well, gonna continue. When this major flag recently broke down, it wasn't just some random out-of-the-blue crash. No, it was the execution of a highly documented technical setup, and that exact setup triggered the massive billion-dollar liquidation cascade we just talked about.
Moving on to Section 2, the historical bottoming process.
Now, this is where things get really interesting. When we zoom out and look at the data across every major bear cycle, it operates like absolute historical clockwork. Back in 2015, 2016, and the COVID panic of 2018 and 2019, the price touched and briefly breached the 200-week moving average. The 2022 FTX collapse breached it. And right now, we are approaching and testing it all over again. Literally 4 out of 4 times the price tests this exact average. So it's really not the end of the world, folks. It's just historical clockwork doing its thing. Look, if you're feeling completely exhausted or just plain bored by your crypto holdings right now, your feelings are totally valid. This sideways, totally apathetic, losing interest grind, what a lot of people like to call chopsolation, is actually an entirely necessary phase in the bottoming process. Honestly, it's basically designed to shake out the impatient money.
Which brings us to Section 3, fear, volume, and fair value.
You see, the market is currently being pulled by something called a point of control, or POC for short. This is the exact price level where the highest amount of trading volume happened during a specific time period. Basically, it represents fair value, the exact spot where buyers and sellers finally agreed on a price. The reason the price bounced right here recently is because it's the absolute bedrock of that fair value. It acts like a giant invisible magnet.
And here's the fascinating part. While the actual price levels are super similar to previous crashes, the underlying psychology has fundamentally shifted. That extreme cliff-edge panic we saw earlier, it's faded into just regular, everyday fear and even outright apathy. The sellers are exhausted, the weak hands have left the building, and sheer panic is basically turning into boring, predictable stability. All right, let's pivot a bit to Section 4, Megatrends, Regulation and Tokenization.
So, looking past the charts, let's check out the massive macroeconomic trends. On the regulatory front, the U.S. Clarity Act is moving incredibly fast. It was introduced, navigated committee hearings, passed the Senate Banking Committee with real bipartisan support, and right now, it's sitting on the Senate calendar just waiting for a full floor vote. So institutional legitimacy is literally knocking on the front door.
And make no mistake, traditional finance is fully aware of this. Just listen to the CEO of BNY Mellon, a bank that manages literally trillions in assets. They explicitly noted that they want to attach themselves to these big market cycles, emphasizing that digital assets aren't just about stablecoins, it's also about tokenization. Think about that. The oldest banks in the world are actively, right now, evolving their assets to live securely on-chain. To put that into perspective with some hard numbers, the total market cap of on-chain tokenized stocks is absolutely exploding. We are currently sitting at a record $1.6 billion.
That is a whopping 240% year-to-date increase. So while retail investors are panicking over daily price dips, the big institutions, they're quietly tokenizing traditional assets at a record-breaking pace.
And the infrastructure to support this, it's already here. Major networks like Ethereum and Solana are actively powering this massive tokenization megatrend. Even more incredibly, both the SEC and the CFTC are actively preparing frameworks for trading these tokenized stocks. This is definitely not some fringe internet movement anymore. It is a foundational shift in how global value is transferred.
Finally, Section 5, Patience and Mean Reversion.
We all know that right now, AI and highly anticipated IPOs, think SpaceX or OpenAI, are drawing massive hype and trading volume. But history gives us a really clear warning here. Think back to hot past launches like Coinbase or Robinhood. Sure, they spiked initially on pure euphoria, but the end result? All hot markets eventually drop to find their true fair value. The hype, for sure, always cools off.
Because at the end of the day, everything reverts to the mean. That's the core takeaway of this explainer. Traditional stocks are currently stretched incredibly high, floating on pure AI euphoria. Meanwhile, crypto is doing the exact opposite. It's reverting down to its 200-week moving average, really solidifying its fair value, all while institutions are quietly building behind the scenes. Fair value is the ultimate magnet for both overhyped stocks and crashing cryptos.
So, I'm going to leave you with this thought. With traditional stocks absolutely soaring on pure hype and crypto currently testing its historical fair value amidst massive institutional adoption, which market is actually the most undervalued right now? It's a pretty fascinating perspective to consider when all the headlines are just telling you to panic. Thanks for joining me for this explainer, and remember, always keep zooming out.